Hey, what's happening, guys? Dan Darrow here from Options in Play. Today I'm going to talk to you about Strangles and Straddles, one of my personal favorite option strategies, okay? And what I love about Strangles and Straddles are that you don't have to approach a trade from trying to pick the direction, right? And trying to pick the direction from a trade can be challenging enough on its own, but when you have earnings, right, huge catalyst, and you have all sorts of different expectations, it can make it even more challenging on top of that, right? So straddles and strangles, right? Volatility strategies, they're looking for big moves in either direction. So not necessarily bullish or bearish, right? They're just looking for a move in excess of what the option market was pricing it, right? So that priced in move, right? We talked about it. It's the at the money call, at the money put. You add that together, that's the price to move. So when you're looking at a straddle, when you're long a straddle, you're looking for a move in excess of what that price to move is, all right? Now, Walgreens, just one example, but could be any other stock out there, right? It's like the name isn't what's important; it's the idea behind it. Okay, so going into earnings, had like a good look to it, right? It seemed like the chances of a bigger move were possible. Had expanding volatility in November, kind of cooled off, consolidated, and going into the quarter, I wasn't sure whether it was going to go higher. Wasn't sure whether it was going to go lower. I was just more of the opinion that it was going to have a big move. Okay, and what's interesting is that the market up a ton today, and you can see why people love earnings season, right? It's because the stocks move kind of regardless of what the market's doing. So the market could be up a ton, but if a stock has really crummy earnings, then it could be down a ton. So it's more about the stock and less about the overall market. Okay, now straddle, right? So Walgreens went out yesterday right around 59, so you could see, right? So like the straddle, it was pricing in, it was pricing in about 250. All right, so just about $2.50, and you can see, right, that this is the 59 strike call. It got absolutely creamed today. Okay, it lost $1.39. Right, so it's trading for only a few cents, but on the other hand, the 59 strike put, right? So like the straddle is the 59 call and the 59 strike put. This has gained substantially. It's gained $1.92. All right. So it went from basically $1.20 to up above three. So 310 or so. It's 315. So if you add the two, if you had bought the straddle, right, not trying to pick a direction, only trying to determine whether or not it was going to move more than that price to move amount, right? If you just bought the 59 call and the 59 put, right, and closed them out like during the afternoon after the stock settled down, right, the call would have lost $1.39. The put would have gained $1.92, right, and then you'd be up for the trade. So you didn't have to determine whether it was going to go up or whether it was going to go down. You only had an opinion that it was going to move more than the priced in amount, right? And that's why traders love straddles and strangles around earnings season, is because you don't necessarily have to be right on the direction. As long as you are confident that it's going to move more than a priced in amount, you can make money that way. All right. So if you like these videos and you're looking for more information on options education, options trading, trade ideas, please follow up with the link in the description of the video for more information on options to play. All right? Have a fantastic night, and I'll talk to you all soon.